Happy June, Jason.
It's June. Yeah, we're midway through the year. It's gone pretty quick.
I know. But it's also time for tax planning.
It is tax planning month, and we are looking at how last year's return impacts sort of this year's decision making, particularly getting, a little bit more runway as far as the time left in the tax year that we can actually make changes and do things. And so that's why, in addition to year-end tax planning, I think a mid-year tax planning in some circumstances is useful. Yeah, is very helpful.
Yeah. And, well, of course, it's June, and we just skipped the whole month of May and the second half of April, at least for folks who filed by April 15th this year.
Yeah.
Why do you like to take that little break before you start to get into tax planning?
Well, for one, it's a busy time, right? It's an overwhelming process in a lot of respects as far as just, the volume of stuff to do, right? And so it sort of helps flush out both for clients and for myself, like all of the stuff, because everyone's gathering documents and getting stuff together and reviewing the return. And we were, over here preparing it and this and that. So it's just sort of that time to take a step back, right? Make sure you get sort of fresh, if you will, and ready to kind of tackle it. And then, right, it gives you that opportunity to, right, we'll gather that information, additional time as far as like what's going to be considered, right, and just gives you a little bit of leeway as far as like not having this sort of direct kind of connection to getting your prior year tax return done.
That makes sense, yeah, especially for the people who really tried to squeeze everything in maybe in those final days before
Sure.
April 15th. Okay, so we take a little break, get a little further into the year, like you said.
Mm-hmm.
And that's what we're going to get into on this episode of Money and Taxes from BB to XYZ, where we break down a single money topic and explain how it could affect those across the generations, from baby boomers to X, Y, and Z. I'm Regina Neenan, certified financial planner and accredited behavioral finance professional.
And I'm Jason Speciner, certified financial planner and enrolled agent. And as the last part of that title tells you, I am into this tax planning season already, and we are getting into the nitty gritty of some mid-year tax planning to make some decisions again, as we talked about, with a little bit longer runway in the tax year in 2026.
Yeah, so we're a few months in, 5 months behind us now, but quite a few months ahead of us.
Right.
I know one bright side of that is that it gives people time to plan before, November, December, when they're trying again to kind of squeeze everything in, squeeze a little more tax lemonade out of the lemons toward the end of the year. So what should people be looking at now, especially if they're kind of glancing back at their 2025 tax returns? How can they start to get prepared early for the 2026 tax year?
Yeah, I think a big thing that's going to come up this year as opposed to last year was, right, we've had this sort of 1 year into some recently pretty, I don't want to say dramatic, but pretty significant tax law changes, a lot of things that made a lot of what were temporary things permanent. And so I think it's more of now we've had that sort of adjustment year. We've had that period of time to sort of sort out where we're going to fall in all of this and how it's going to affect us. And we can talk about some of the, more specific carve-out pieces here in a minute. But now it's really understanding, okay, now that we have our arms around, how this applies, like building on that, if you will, right? Building on that sort of success in that understanding, in that planning. So everything from, how you make charitable contributions to what kind of, retirement accounts or health savings accounts or 529 plans or all these various things that you're contributing to, how that's going to start to fit into it. And it gives you, again, more time within that tax year, right, to do certain things, especially that have a year-end deadline that maybe you want to plan out a little bit more. Charitable giving being one of those significant ones. So it gets us this opportunity to kind of get going with positive change.
I think I am maybe most excited personally about the charitable giving piece, so I cannot wait to get into that.
Mm-hmm.
But looking back, I remember when the One Big Beautiful Bill Act came out last year, that it happened during the year, but there were some pieces of it that were retroactive to the beginning of 2025 for that entire tax year. And then there were some kind of smaller changes that transitioned from 2025 into 2026. So excited to get into these with you. Jason, where do you want to start?
Well, I think like we can look at those changes, right, that became effective, in the end of 2024, or basically for the 2025 tax year, and then the ones that are going to become or are tax law right now in 2026 because they were effective after December 31st of 2025. So things that became all right, effective immediately, if you will, when the One Big Beautiful Bill Act passed, right? Standard deduction being made permanently higher amounts for all taxpayer and filing statuses. There was also a change to the SALT, right, deduction, which is the state and local income tax deduction. That was moved or changed from a $10,000 firm, $10,000 cap, up to $40,000 for most taxpayers, right? There's still high income taxpayers that will still have, the SALT application at a lower amount, like a $10,000. Child tax credit was immediately increased last year by about 10%. So it went from 2,000 to 2,200. And so there was some really like immediate sort of effects. And then a lot of the stuff that's taking effect in 26, primarily, and I guess that's also, I should include the additional deductions, right? Like the age 65 plus deduction, the tips and overtime deduction that became effective again last year. Now, with this year's changes, a lot of them, most of them, are making permanent what was temporary in the Tax Cuts and Jobs Act of 2017.
Ooh.
Yeah. So things like the miscellaneous 2% miscellaneous itemized deductions that was made permanently, like that's not a thing anymore. Moving expenses, again, not a thing anymore unless you're a uniform service member in a very specific sort of scenario. Same thing with personal casualty losses being linked to disasters and so on. So you go down the list of all of these things that you were familiar with Tax Cuts and Jobs Act that is now just a permanent part of the landscape and not, which was set to expire this year, no longer going to expire.
So some tax cuts made permanent, some bigger deductions that people can look forward to. Let's
Yes.
say I'm looking at my 2025 tax return because I actually have already filed mine this year, patting myself on the back for that. I'm looking at that. Where should I look to see, where I might have qualified for some of these last year or where some of our listeners might have, and whether it's something that they should at least be mindful of kind of heading toward the midway point of the year?
Yeah, that's a great question. So on your 1040 from 2025, if we're just talking about deductions, right? And whether or not you received an increased SALT, right, deduction or state and local income tax deduction, whether you received any of these additional deductions, right, that's going to be on lines 12E, which will show your standard or itemized deduction. Of course, if your itemized deductions exceed your standard deduction, you would include a Schedule A, and that Schedule A would have the information that would lead you to understanding where your state and local income tax deduction fell. For the other deductions, or additional deductions, I should say, line 13B has the sort of total from Schedule 1A, which that includes the age 65 plus deduction, right, which is $6,000 per taxpayer. Married gets a $12,000 deduction there. The no tax on tips, or basically the qualified tips getting sort of subtracted, right, from taxable income, and then the overtime, the no tax on overtime, again, that qualify that time, that half, right, that additional amount of overtime, counting towards that and being, subtracted from your taxable income.
Okay, so I'm looking at my 2025 tax return, line 12E, you said it was?
Yes, 12E, standard
Okay.
or itemized deduction, and you'll see either the amount of the standard deduction for your filing status, which will be on the left column there, you'll see that, or you'll see a larger amount, which means you itemized.
Okay, I took the standard deduction. If I
Okay.
am thinking about maybe should I start tracking some of my potential deductions to go the itemized route, what are some things that I should be looking at?
Yeah, no, this is a really common question. And I think a lot of it also ties back to like medical expenses, right? Especially. I get that often. Oh, we had a, high medical cost year, and, how should we look at itemized deductions? Now, keep in mind though, with medical expenses, they have to exceed 7.5% of your gross income. So if you're a
Oof.
high income family, like you could have a lot of medical expenses and it still doesn't even count. And then once it exceeds that 7.5%, it's basically every dollar over that, right? So $1 counts at 7.5% of your adjusted gross income. So that's one spot, and that's one thing that, hopefully you'll have an easy source for that. Like, you don't have to go and tabulate every single receipt. Maybe your insurance statement shows what your out-of-pocket responsibility was, something along those lines.
Hmm.
Your state and local income taxes, I mean, I hate to use this phrase, but they are what they are, right? They are simply the amount that you pay in income tax, in property tax, in, potentially sales tax, depending on where you live.
Mortgage interest?
Mortgage interest is there as well, but again, the same sort of scenario, right? There's, a few pieces that can go into that, right? So you could have, points paid on the purchase of a primary residence, or maybe you're amortizing points from a prior refinance or something along those lines that could add to that mortgage interest figure, but nothing really that sort of jumps up as like, you can control this. The biggest one that is under your control, of course, then is your charitable deductions, right? Like, what sort of contributions were made to charities that you can now deduct on that Schedule A, and that's the place you do it. And so that's where you can really start to, especially if you have things beyond just like, I don't want to write a check for $10,000, but I have $10,000 of appreciated stock that I could give, skip out on the capital gain for, and also get that tax deduction. Those are where those opportunities really start to show up.
I know that we really look closely at that toward the end of the year when we see what kind of, again, lemonade we can get out of the tax lemons.
Yeah.
But one that I was really excited about is the above the line charitable
Yeah.
contribution deduction.
Yeah. So this exactly ties back to that. So let's say you take a standard deduction, right? You don't have that opportunity to then calculate what your charitable deductions were. Now, if you think about it, right, when you get a standard deduction, you're winning with that. The reason you're winning is you are able to deduct more expenses than you actually incurred in most cases, right?
Mm-hmm.
When you claim that standard deduction up until, well, I guess there was 1 year back in the kind of the COVID era, if you will, where this was true as well. But most of the time when you take a standard deduction, your charitable contributions are just sort of just charitable. They don't have any tax implications, et cetera. Now, beginning in 2026, there is what's called an above the line. Now, the line, if you want to know what that is the figure essentially that links together pages 1 and 2 of your Form 1040. So line 11A and B, it's the same amount, right? 11B is just amount from line 11A, which is your adjusted gross income. That is your line. So if you take a deduction above that line, it means it reduces that AGI. And if you take a deduction below, which is like your standard or itemized deduction, of course, now that AGI is reducing your taxable income further, right? All of this is a very sort of detailed way of explaining that the deduction that we're talking about here, you're not even going to see in your 2025 tax return because there's no line for it yet. But there will be a line on your 2026 return that will say, charitable deduction, and probably something if claiming standard deduction, or see instructions usually. And that is where you will get to claim an additional $1,000 per taxpayer, $2,000, of course, married filing jointly, in charitable deductions above and beyond your standard deduction if you claim that.
Yeah, I love being able to tell folks when they're asking for donations for different charities, I haven't developed my charitable giving strategy quite yet.
Yeah. Yeah.
I'm still deciding where I want to give my 1,000 to.
I'm still working with my tax planner to determine, yes, exactly
Yeah.
how I'm going to make the most effective use of my charitable contribution strategy. One other place I always like to, just evaluate in any tax planning scenario is the payments and refundable credits section, right, of a 1040. And because this
Ooh.
gets into a lot of different things, right? Reggie, I'm sure you'll appreciate from a cash flow planning perspective, like how much is being withheld from a paycheck or a retirement plan or whatever, could have a dramatic impact on how things are working out on a cash flow basis. And of course, what kind of tax bill they have, right? Which is another cash flow planning consideration in and of itself.
Same with HSA savings.
Yes, precisely. Now HSA savings is another above the line deduction, right? So now we're focusing here on the amounts that are paid or credited, right? They're sort of like count as money that you paid in, which aren't necessarily always amounts that you actually did pay in. Sometimes you have what are called refundable credits, usually the education credits, American Opportunity Tax Credit, for example, being one of those, adoption credits and so on. Like that all counts as like a payment. Right. But what we're looking at here is we're trying to figure out the optimization of essentially one thing. And that is you want to pay in during the year the amount you're required, which is the minimum amount that you need to pay in to not have to pay an estimated tax penalty. And then effectively leave yourself with the remainder of that balance due. Right. That would be like on the screws. Right. Now, if you get with plus or minus $1,000 of zero, I think that's the more practical way to try to tackle this generally, unless it's a really significant bill. Unless hey, we're talking like you're going to owe like, a couple $100,000. I would never overpay that on purpose ahead of time. Earn interest on that money first, right? And then, make sure that you're getting it paid on time when it comes to your tax bill. So this whole section, payments, refundable credits, looking at that, what's changing from 25 to 26 is critically important to understanding if there is going to be any sort of issues or needs to do any sort of, maybe you make an estimated payment, maybe you make an additional withholding from a retirement account distribution, whatever that might be.
Yeah, Jason, one of my favorite things that I actually borrowed from you is don't give the IRS a tip. And I've even heard some of our clients, even new folks who have not worked with us before, come in and they kind of repeat that. So I wonder if they, like some of our listeners, have heard you say it just on the podcast instead of in person.
Don't tip the IRS. And I've for surely borrowed that from a fellow professional at some point. I've heard it numerous times, like lots of phrasing on it, but right. Not forget about no tax on tips. Don't tip the IRS. And an estimated payment penalty is essentially that, right? So we want to optimize for not only, again, maximizing the dollars that you ultimately are keeping productive, but also, again, not having to pay a little bit extra on that tax bill.
Well, with that, let's get into today's takeaways. And Jason, I'm actually going to let you take it away with your top 3 tips of turning your 2025 tax return into 2026 opportunities that our listeners can be on the lookout for.
Yeah, I mean, and really it's starting with the 3 different sections that you're going to have to evaluate, right? So you take a look at your income on your 1040. That's the first page of your 1040. That's all the money coming in, right? There's also those above the line deductions. Are you enrolled in an HSA this year and you can now contribute, or a high deductible health plan that allowed you to contribute to an HSA? Are you going to make charitable contributions when you have not claimed a itemized deductions for years, but now all of a sudden you're actually gonna have a tax benefit for it, right? So evaluating all of that above the line stuff, income coming in and those above the line deductions, and figuring out what is going to be different or unique about this year is step 1, of course. Then looking at those deductions, your itemized deductions, if that's the case, if you're paying mortgage interest and have state and local taxes, have medical expenses, all of those things. Again, how you control that, right? So part 2 here is how you can control what those itemized deductions are, specifically like the most controllable one, of course, being those charitable contributions again. So it's sort of, how you give money is ultimately a determining factor in what kind of tax bill you might end up with. And then number 3 is, again, that payments and credits, understanding what changes have happened from 25 to 26 as far as your withholding from your job or from your pension, as far as any credits you were previously eligible for that maybe this year you're not. So, for example, you have a kid who was in school that you were paying and getting American Opportunity Tax Credit. Now you're not getting it. Getting those zeroed in to, again, the optimal outcome. Takeaway, kind of bonus takeaway here. Biggest takeaway is, again, the optimal outcome is paying in during the year as little as you possibly can while not having to pay an estimated tax penalty, and to continue to keep your money productive in the meantime.
Well, how about you? What are you looking at on your 2025 tax return that you're thinking about bringing into 2026, or maybe looking for a new opportunity this year? If Jason missed anything, reach out to podcast@fpfoco.com to let us know, or reach out to us on one of your favorite social media channels @FPFoco.
Yeah, I'd love to hear about it. And yeah, always talking taxes is fun for me, so I appreciate the opportunity to do that. And thanks for listening, and we'll talk to you soon.
Jason Speciner and Regina Neenan are investment advisor representatives of FPFoco, a registered investment advisor. The information in this podcast is provided for general educational and entertainment purposes only. It may not apply to you or your specific circumstances and should not be considered financial, investment, or tax advice.